video. As you can see, I'm on my own today. Gav's off paragliding around Victoria, as he loves to do. So hopefully he's got some good flying weather. Pretty crazy week for the market. We touched a new record high yesterday, just after the market opened. We hit 92.02, so that was a new record high. A lot of solid buying in the resource sector really pushed our market to those extremely hot levels. It's interesting, we didn't really see the market back over 92 all day after the open, so we sort of slipped away. I think the highest we saw after the open was around 91.90, so a little bit hot at the start, although still a very positive day. Interesting, over the last couple of weeks, if we look at what's driven the market, CBA and BHP have added $140 billion in market cap. That's probably about 100 points to the index, those two stocks combined. And within that period, we also had CBA go ex-dividend. So it's been a phenomenal performance from those two market leaders, obviously with the support of Rio Tinto in the resource sector, and the other banks have had very, very big moves. NAB probably a standout, up about $6 since its update, and both ANZ and Westpac have followed course as well. Looking at other things that took place this week, we had Fortescue come out with an update, and the numbers generally looked okay, but it's certainly lagging the other two major resource companies. It's sort of sitting just under $21, where probably if it had been following the moves that BHP and Rio had made, it'd probably be up around $24, $25. So Fortescue looks a bit interesting. Targets are still around the 2050 mark, so it's certainly not getting a lot of analyst support. I did feel the numbers yesterday were quite reasonable, and the dividend that they're offering is pretty attractive. So I do expect a bit of buying will probably move into those two stocks. Looking at research targets, we've got BHP currently $52.58 the research target there, and Rio $152 a share. So both trading at very big premiums to the current sort of 6-12 month targets, and also both going ex-dividend next Thursday. So there could be a little bit of selling post those dividends. Certainly, it feels that at these levels, very hard to justify, especially with both basic at record highs. Looking at our local banks, we received updates through the early stages of this month, and they were all pretty positive updates, but all of the banks have moved to levels where they're really not pricing in any downside risk in lending markets, and not just local lending markets. I sort of look at global lending markets. Yields are certainly at levels where, certainly over my years of experience, we never bought banks when the yields were at such low levels, and especially not, let's say in the case of CBA, below the current cash rate. Why would you buy a bank and get a yield of sort of sub 3% when you can put the money into a cash term deposit and probably get a slightly better rate without the risk? So very difficult to justify buying a bank at these levels. For clients that own the banks, I think you really should be looking at whether you lighten out some of your holding, which I've had quite a few people do over probably the last week or so. Or look, writing some covered calls is always a good strategy. You could look at writing some calls out to May, which would get you past the dividends for the case of ANZ, National Bank and Westpac, and you could write a European contract that would mean you'll get the dividend no matter what, and then you'll get some good option premiums. So that's definitely a strategy that we'll be looking at for a lot of clients that own the banks. And also, if you are long banks, it wouldn't hurt to look at some downside protection. These levels just seem a little bit far-fetched to me, and when we've got the government looking at changes to capital gains tax on property, there could be some movements that might see the banks take a bit of a dip at some stage soon. One of the big concerns I've got with the banking sector, and it really revolves around private lending in the US. Right now, and Jamie Dimon, the CEO of Citibank, came out with some comments basically saying it was something that they were very concerned about. And I did post an article in our weekend read a couple of weeks ago about US property sales, and it was showing that about 1 in every 4 to 5 sales is falling over at settlement. And that's basically because lending is not being available, people aren't meeting the requirements, or they're pulling out post purchase for whatever reason. That is a real worry. It does show to me that maybe Trump's view is right. They really do need to drop rates. It seems to be a very two-speed economy with a booming share market, but obviously a housing market that is starting to see signs of troubles. So something to be very concerned about. And it is likely, if it does see, if we do see a big collapse in that US private lending, it will flow through to banks, and obviously it'll become a bit of an international issue, because I think a lot of our banks will have some sort of exposure, whether it be via their own borrowings or a drying up of capital markets where they need to raise. Couple of other things over this week. Woolworths came out with results and really blew the market away. Woolies had been on a pretty good run up to around $32, $33. We had certainly been talking about that being where we thought the top might be, and had suggested selling some calls or even lightening out of the stock and moving into the Coles group. Well, we were sort of blown away when Woolies jumped about 10 or 12% on the day it reported its results. Stock at the moment, $36.35. Anyone who does own Woolworths, I think at $36 or higher, you would be very sensible to take some profits, selling down some stock here and just maybe sitting on some cash. And that's probably a strategy I'm going to be looking at across the whole market for investors that are exposed to sort of broader market products, like one of the Vanguard ETFs, which is something we buy for a lot of clients. It really is one of the times to take some cash off the top, sit back and see what this market does over the next 2 or 3 months before maybe looking to re-enter. That's probably all I had to update on this week. Obviously, we're still watching a very hot market. We really feel a bit of a pullback is likely. But when that happens is going to be interesting. I think when these final dividends come out over the next sort of 5 to 10 days, that could be where the market starts to turn. So something to be wary of. And if you'd like to talk about it more, get in touch with myself or one of the other advisors, and I'm sure we'll be able to work through it with you. Thanks for that. Bye.